Level 1, the tenant. You're 23 years old, refreshing an email that hasn't come 4 days from needing somewhere to live. Application fee, $50, non-refundable, already gone. When the email arrives, it's 2 lines, not approved, income requirement not met. Your gross pay is $3,167 a month. The unit is $1,350. Rent times 3 is $40.50, and you're short by almost $900 on paper, despite never once being late on anything in your life. Nobody explains the rule before you apply. You just fail it. You ask the person closest to it. Your own landlord, Frank, an older guy in a fishing shirt who owns the duplex you already live in, how he decides who gets approved. He shrugs. The rent has to cover the mortgage with something left over, and if he doesn't check whether a tenant can actually pay it, he's the one who eats the loss. That's the whole business, explained in one sentence over a rent check. You go home and, instead of scrolling more listings, start Googling how the mortgage part of that sentence actually works. You don't have an answer yet. You have, for the first time, a version of your future that isn't just renting from someone like Frank for the next 30 years. Level 2, the agent. Within the year, the anger turns into a plan you can actually work. You automate $400 a month into a separate account the moment your paycheck lands, cut your own rent by downsizing into a smaller studio, and realize the real unlock isn't the money you're saving, it's the data you can't see yet. Real sold prices, real vacancy rates, landlords quietly looking to sell before anything hits a public listing, all of it sitting behind the MLS login only a licensed agent can access. Getting that login costs less than you expect and more time than you have. A $700 pre-licensing course, a $60 exam fee, 6 weeks of night classes stacked on top of your regular 9 to 5. You pass on the first attempt. You join a small local brokerage part-time, the kind that takes on agents working evenings and weekends instead of full-time, and you do the least glamorous version of the job that exists, covering open houses nobody else wants to work, running comps for other agents' listings, answering rental inquiries after hours because none of the senior agents want to bother with them. Your first commission comes from placing a tenant in a landlord's vacant unit, not from selling anyone a house. 1 month's rent, $1,350, the exact number that once rejected you, now landing in your own account instead of someone else's. Through the brokerage, you meet actual small landlords for the first time as a peer instead of a tenant, 3 or 4 of them owning between 2 and 15 units each, and one of them, walking you through why he's pricing a listing the way he is, uses a phrase you've never heard, cap rate. You ask what it means. He explains it in one sentence. Take what the property earns after expenses, divide it by the price, and that's roughly the return. The same math whether it's a duplex or a shopping mall. You write it down. The access changes what you notice too. Pulling comps for other agents, you start seeing the same pattern repeat in one specific stretch of the city. A few neighborhoods over from where you grew up. Vacancy sits under 3%. Days on market for a decent rental barely crosses a week. And rents have climbed for 3 years running, while purchase prices have lagged behind because the area still carries a reputation nobody's bothered to update. Nobody hands you this insight. You just start seeing it because you're the one pulling the data every week instead of reading somebody else's summary of it. You don't buy anything there yet. You can't, but you start driving through that stretch on your days off anyway, looking at duplexes, quietly doing math nobody else can see. Level 3, the house hacker. 10 months later, you have $22,000 saved, and a duplex in that exact stretch of the city goes up for sale at $270,000, both units occupied, the owner retiring after 4 years of never raising the rent. You don't feel ready. You're 25, you've never been personally responsible for someone else's roof, and the idea keeps you up 2 nights running the same math you already know the answer to. You decide ready is a decision nobody hands you, not a feeling you wait for, and you use the loophole you researched a year earlier. An owner-occupant loan meant for someone buying a home to live in will finance a 2 to 4 unit building at 3.5% down as long as you live in 1 unit yourself. 3.5% of $270,000 is $9,450, most of what you have, plus closing costs covered by 3 more months of commissions you haven't earned yet at the time you sign. You move into the smaller unit. The larger one is under-rented at the old rate, so you do the work you were trained to do at the brokerage. Real photos, a listing pushed across 4 sites at once, a description written the way you'd write it for a client. Applications come in within a week. You run the exact screening test that once rejected you, gross income at least 3 times the rent, not from memory but because you finally understand why it exists. You're the one who eats the loss now if it's wrong. A single mother named Denise signs the lease, first month and deposit combined, $2,000, landing in an account that until that exact moment was just a spreadsheet with your handwriting in it. That signature is the actual first sale of a business that doesn't have a name yet. Not the closing, not the keys, the first dollar someone else chose to pay into something you built. Your own mortgage payment, taxes and insurance included, runs $1,900 a month. Denise's rent covers most of it. Your own housing cost drops from $1,350 to $400, less than a third of what a comparable one-bedroom costs 3 blocks away. You didn't get rich. You got your biggest expense cut by nearly $1,000 a month, and for the first time in 2 years, your savings account starts refilling instead of just emptying into someone else's. Level 4. The Landlord. 14 months later, Denise renews, at a small increase she doesn't argue about, because rent in that stretch of the city has kept climbing exactly the way your old comps predicted. That renewal matters more than the first signature did. The demand isn't a fluke you caught once. It's structural. The market genuinely wants this, and you were early enough to notice. You want a second property, and this time you can't use the owner-occupant loophole again. You already live in one. You save the conventional way for the first time, 20% down instead of 3.5% on a $180,000 single family a few streets over. Between what's left of the duplex savings and 14 more months of day job plus commissions, you scrape together the $36,000 down payment and closing costs, and it takes nearly the entire 14 months to do it, even with 2 incomes feeding the account. You close, you fill it, it cash flows. And sitting with the spreadsheet the week after, you run a number you hadn't bothered running before. At this saving pace, roughly $3,000 a month between both incomes, funding a full 20% down payment on the next property takes over a year, every single time, no matter how well the existing properties perform, because none of that rental cash flow is actually reaching your down payment account fast enough to matter. You could own 40 properties someday at this rate. You'd be 65 before you got there. Something about the math has to change, and it isn't going to be your income. You start reading again the way you did at 23. Except this time the question isn't how any of this works. It's how people who started exactly where you did manage to grow faster than their own savings account allows. Level 5. The Rehabber. The answer, when you finally find it in a forum thread at midnight, has an acronym you've never heard. BRRRR. Buy, rehab, rent, refinance, repeat. A landlord you met through the brokerage 2 years ago mentions he's finally unloading a single family he inherited, boarded up, one oversized bedroom, condemned for a partial roof collapse, priced at $95,000 because no conventional lender will touch it in that condition. You finance it with a hard money loan, a short-term loan from a private lender charging 12% interest and 2 points specifically because nothing else qualifies. And you budget $55,000 for the work. A new roof, a full kitchen and bath, and the decision that actually changes the return on this deal, framing a wall and a closet to legally convert the single oversized bedroom into 2. Comparable one-bedroom houses on that block rent for $1,150 and sell in the 160s. Comparable 2 bedrooms, same square footage, rent for $1,650 and sell in the low 200s. The conversion itself costs about $18,000 of the $55,000 budget. It's the single highest return line item in the entire renovation. You put roughly $75,000 of your own cash and hard money draws into the deal from purchase through renovation. An appraiser, walking the finished 2-bedroom, values it at $210,000, well above the $165,000 it would have appraised at with a cosmetic renovation, and no conversion. A conventional lender refinances you at 75% of that new value, $157,500, enough to pay off the hard money loan completely and put almost all of your own cash back in your pocket. What's left permanently in the deal is close to $12,000, against a property now renting for $1,650 a month, instead of the $1,150 it would have commanded unconverted. You didn't just force appreciation, you recycled nearly all of your capital back out, which means the next deal doesn't require another 14 months of saving from a paycheck. It requires finding the next distressed property and doing this again. For the first time since Frank explained his one sentence over a rent check, growth stops being limited by how much you can save. Level 6. The Professional. You run the same play twice more over the next 2 years. Each one a little faster than the last because you know exactly which properties qualify, exactly which contractor to call, exactly how long a refinance takes once the final inspection clears. Between the duplex, the conventional single family, and 3 BRRRR deals, you're carrying 9 units now, and the portfolio produces roughly $3,200 a month in net cash flow after every mortgage, every expense, and a maintenance reserve you started keeping after your first 11 p.m. plumbing call caught you at your actual desk job. Your day job, after tax, puts about $2,800 a month in your account. You've been running that comparison every week for months, watching the gap close, and the actual break-even point, the one that matters, isn't the month the rental income first exceeded the mortgages 2 years ago, it's this one. The month the properties alone, without the paycheck, without the weekend showings, can cover your entire life and still leave something over if a unit sits empty. The decision isn't really about the money anymore by the time you actually make it, even though the money is what finally makes it possible. It's about where your attention has already gone without your permission months before you admit it out loud. You're taking maintenance calls from a stairwell at your desk job. You're refreshing a rent collection app during meetings that used to hold your full attention. You're doing lease math in the margins of a notebook meant for someone else's project notes, and the work you're actually paid 40 hours a week to do has started to feel like the side hustle, the thing squeezed into the gaps around the business you built after hours. None of it was ever a passion, if you're honest. It paid the bills while you figured out what would replace it, and it did its job, and now it's just in the way. You give notice on a Tuesday afternoon that feels smaller than it should, given how long you spent building up to it. Your manager asks what the new job is. You say landlord, and feel ridiculous saying it out loud for the first time, the same way it felt absurd 2 years earlier to admit the plan to anyone at all. Walking out on your last day, badge handed back, desk already cleared into a single box, the feeling that actually hits you isn't pride and isn't even relief exactly. It's something closer to space, the specific physical sensation of a schedule that used to belong to someone else belonging entirely to you instead. You keep the brokerage license active, not out of caution, but because the MLS access is still worth more to the business now than the commissions ever were. With the day job hours back, you personally manage every unit for the first time without triaging between 2 jobs, answering maintenance requests inside the hour, walking every vacancy yourself before it's listed instead of trusting photos alone. Occupancy across all 9 units holds at 100% for the first time since you started, if a business this size can be said to have a since yet. Level 7? The manager. 2 more years of full-time focus turns 9 units into 19. 1 refinance and 1 BRRRR cycle at a time, and 19 is the exact point where doing everything yourself stops being efficient and starts being the actual limit on how fast you can grow. You hire your first help, a handyman on retainer for $800 a month who handles anything under $250 without calling you first. Buying back roughly 10 hours a week you didn't know you were losing to garbage disposals and running toilets. You formalize the referral channel you'd been running on instinct. A $100 credit to any current tenant whose friend signs a lease, cheaper per tenant than any paid listing, and faster than any free one, because people trust a friend's landlord more than a stranger's photos. You start tracking cost against speed the way you never bothered to before. A boosted listing runs $30 and fills a unit in 4 days on average. A free marketplace post fills the same unit in 11 days for nothing, if you're willing to answer messages at tenant night instead of paying to skip the wait. You build the rest piece by piece, one online application form instead of a patchwork of texts, an automated rent portal that drops late payments from 4 a month to 1, a listing tool syndicating a new vacancy to 6 sites simultaneously instead of you posting to each by hand, cutting average vacancy from 25 days to 9. None of it feels like a big decision individually. Combined, it's the difference between a business that only runs because you personally never stop, and one that survives a bad week without you catching every single thing. This is the year the portfolio produces its first genuinely sustainable profit, not the kind that shows up because rent happened to land well against expenses one quarter, but a consistent margin, month after month, even after paying the handyman and the referral credits and a reserve you no longer skip. You put almost all of it back into the next acquisition, because growth eating the profit on purpose, for a while, is the only version of this that actually compounds. Level 8. The Survivor. 26 units in, spread across 5 streets, in the same few neighborhoods, and the local economy hits you with something you never modeled for. The county's second largest employer, a distribution warehouse 3 miles from the original duplex, lays off 400 people in a single announcement, a meaningful chunk of your own tenant base among them. Rent that used to arrive on the 1st starts trickling in on the 9th, the 15th. Not at all. Within 2 months, 6 of your 26 units are behind. And at the same moment your insurance renewal comes back 40% higher, a regional pricing shift with nothing to do with your specific properties and everything to do with a bad storm season 2 states away. You don't evict on the first mispayment. You call every tenant who's behind personally, something almost no landlord your size still bothers to do, and set up payment plans for 4 of the 6 instead of piling on fees you already know they can't pay. The other two you can't reach at all, and after 30 days of silence, you start the eviction process for the first time in your career, learning in real time that it takes 6 weeks and $400 in court costs, even in a state that moves fast. You cut your own draw from the business for 2 straight months, rather than touch the maintenance reserve. The same instinct Frank probably had a dozen times without ever mentioning it to a tenant dropping a check through his mail slot. You come out the other side 4 months later, occupancy back above 90%, insurance shopped down to a smaller increase with a different carrier, and a rule you write into the business that didn't exist before. Every new acquisition now gets stress tested against the scenario where the single biggest employer in its zip code disappears completely, because you've learned firsthand that it can, and the properties that survive that test are the ones you actually buy from now on. Level 9. The sponsor. A piece of vacant land comes across your desk 2 years later, zoned for a 40-unit apartment building on a corridor where 3 new employers have moved in over 18 months, and rental demand has outpaced anything currently built. The land alone runs $850,000. Total project cost once you price out construction, permitting, architecture, and a contingency reserve comes to $9.2 million. A number that has nothing to do with your personal balance sheet and everything to do with an idea you now have the track record to actually pitch. For the first time, you raise money that isn't yours, an LLC where you're the general partner running the deal, and 12 investors, several of them landlords you met years ago through the brokerage. A few former clients from your agent days come in as limited partners for $3.1 million in combined equity. The rest is financed through a construction loan at roughly 65% of total cost, interest only during the build, priced higher than a normal mortgage at 8.5% because the lender is underwriting a plan that doesn't exist yet, not an income stream that already does. The pitch you give investors isn't a hunch. It's 6 years of documented occupancy, a BRRRR track record with real refinance numbers behind it, and a stress test born directly out of the layoff scare 2 years earlier. Proof the model survives a bad year, not just a good one. Permitting and entitlement take 11 months, longer than you budgeted, a zoning hearing that nearly stalls the whole project over a parking variance you end up conceding on. Construction runs 16 months after that, a general contractor who goes quiet for 3 weeks during a materials shortage while interest payments keep running whether the building exists yet or not. You lease it up starting 4 months before completion, pre-sale deposits building against a waitlist, so the doors open with a third of the units already spoken for. Once stabilized near 90% occupancy, the building produces roughly $620,000 a year in net operating income, and at a 6% cap rate for new well-located construction, that values the finished building at just over $10.3 million, a spread of more than $1 million over what it cost to build, the entire reason you took on construction risk instead of just buying something someone else had already finished. You refinance the construction loan into permanent financing, return capital to your investors on schedule, and for the first time in your career, you've built something instead of just buying it. Level 10. The founder. You don't sell. A regional buyer floats an offer on the whole platform 2 years after the apartment building stabilizes, and you turn it down inside a single meeting, because the thing that actually built this, finding the deal, running the numbers, standing in the room while a contractor explains why the framing's behind schedule, is still the part of the job you'd miss the most if you handed it off. The company runs both sides of the business now. An acquisitions team sourcing distressed and undervalued properties across 4 submarkets, and a small development arm, 3 people deep, currently permitting your second ground-up building 2 exits from the first one. You have a leasing coordinator who screens every application across the portfolio using the same 3 times rent rule you learned from Frank over a rent check 15 years ago, a maintenance dispatcher routing requests to a bench of contractors instead of one overworked handyman, and a bookkeeper reconciling rent across more properties than you could personally list from memory anymore. One afternoon, an applicant gets flagged by your own system for falling short of the 3 times rent rule by less than $100 a month, an automatic rejection about to go out exactly the way yours once did. You pull the file yourself. 6 months of perfect payment history at her current place, a job held 2 years, a shortfall that's really just this city's rent finally outrunning what entry-level jobs pay, the same gap you sat with at 23 doing math on a phone you could barely afford. You approve it personally, the first exception your own system has ever logged with a note in the file explaining why. It isn't a business decision, it's the only kind of decision that actually explains where this started. Not a formula, not a spreadsheet, a $50 you couldn't afford to lose, and a landlord who, for 1 sentence over a rent check, decided to explain the rule instead of just enforcing it. Somewhere in that same city tonight, someone your age 15 years ago is refreshing an email that hasn't come yet, about to fail a rule nobody's explained to them either. You don't know her, you never will, but the rejection she's about to read runs 4 systems, 2 development projects, and 100+ units later, through a company that exists because you once failed the exact same test.